Hi, and welcome to Finextra at Cybos TV. And today we're talking to Jon Richman of Deutsche Bank, and we're going to be talking about the financial supply chain. So, globalization is playing such a greater role in the financial supply chain right at the moment. How are banks responding to this? Are they expanding their global reach? Are they going into a partnership model? How are they better serving their global corporate clients?
Well, you're right that increasingly very large, sophisticated companies are looking to make their financial supply chain programs much more global, beyond just domestic borders. And really, there's only a handful of major global trade banks that can make this happen for them today. In order to do this, you really need to have strong international structuring capabilities. You need robust operations and onboarding skills. You need a lot of credit capacity and distribution capacity to be able to meet the demands of these very large programs. For Deutsche Bank, we are one of those leaders with those capabilities. And over the last few years, we've rolled out a global platform, multi-currency, to meet these needs cross-border for our clients with very tailored processes for operations, for onboarding suppliers or distributors in our various markets throughout our extensive network in all the major regions of the world. And that's worked well for many clients. But having said that, there are cases that we have seen where it makes sense for some of our very large global clients to be able to bring other banks into the equation, where they can add value, maybe because they have local presence somewhere, or they have a particular product capability, or just a strong relationship. And where that makes sense and where our client wants it, we're happy to work in that way. And in fact, we have many cases where we are the sole global lead of a major financial supply chain program across many countries, and in some cases where we've led mandates for our clients, but we've also worked with other banks in partnership to create more value for our clients. So I really see the trend will increase in both directions.
Yeah, but I've been hearing a lot about partnership as well. That seems to be a big trend that banks are going through. Yeah.
Where it makes sense for our clients and those partnerships work, then we can definitely work in those partnerships to add more value. And we have real live examples of that now.
Excellent. So, will the take-up of the financial supply chain services continue at such a rapid pace post-crisis? And are the drivers for growth the same?
Well, there's no doubt that the growth of financial supply chain programs really took off in earnest during the financial crisis, and very simply because liquidity dried up during that period of time, and it was really one of the main sources where companies could still access liquidity. But interestingly, the growth rate continues at really an exceptional pace post-crisis. And what are the reasons for that? Well, treasurers today have, at the top of their agenda, much higher than ever before, the importance of managing working capital metrics and cash flow. They are increasingly looking to standardize their trade terms with their trading partners, to extend those terms to improve their own cash flow, while at the same time they need to make sure that their supply base is stable and supported, same on the distributor side. Everybody wants to increase automation and connectivity, to improve visibility into the process in order to improve cash flow. And financial supply chain solutions, it does all of that. And so during the crisis, financial supply chain proved to be a very good alternative source of liquidity. Post-crisis, financial supply chain solutions is doing that, plus showing that it adds a tremendous amount of more value add beyond just a traditional working capital loan or even what a company could get by accessing capital markets.
So, I wanted to go into a little bit about traditional letters of credit, which doesn't get a lot of love these days, especially with open account openings and new regulations. But is there a place still for traditional letters of credit?
Well, no doubt, the trend towards open account continues, but I really view this as an opportunity. Historically, banks had a very limited role in that space, and what we've done is we've developed financial supply chain solutions for open account-based trade, and it's been an opportunity for banks to intermediate themselves into the process and provide the same kinds of value and benefits on open account trade as we have historically in the traditional areas. Now, there's still a place for the LC, and it's important for many of our clients. It plays a key role. And interestingly, what we call transaction-based finance, where we provide finance on the back of traditional documentary credits and collections, it's actually a growing business for us because, again, it's proven to be a viable alternative source of liquidity. Guarantees, also a very traditional product, is a growing product for us because it's still a very convenient way for our clients to be able to manage the risk in the trade process. There's also some new developments out there. New developments like the bank payment obligation, which to me actually is very similar in its features to traditional letters of credit. And if that can take off, it represents another potential area of real growth for banks and a new way for us to help our clients manage risk, manage cash flow in a more automated and efficient way.
So what about the regulatory impact?
Well, there's clearly Basel III and other regulations are going to have an impact on this business, and there is a lot of discussion in that regard. I do expect, however, that we will be able to properly reflect what I consider to be a very low-risk nature of trade products into the new risk and regulatory frameworks. And when that happens, we'll be able to better manage the impact of any new regulations on this business. But having said that, there will be impact. And I think one of the compensating factors will be an increased focus of banks on distributing their trade assets and trade products into the secondary market in order to be able to better manage their balance sheet and capital ratios while still meeting our clients' demand and increasing our credit capacity. So all those things will happen. But overall, I still expect there to be a growing demand for both traditional trade products as well as the more evolving, newer financial supply chain programs. Deutsche Bank is investing on both sides of this business. For us, it's core, and for our clients, it's very key. And our philosophy is we will help our clients manage working capital, liquidity, cash flow, and risk, and document and data handling, regardless of their terms of trade. For us, it's a growing business, and I think it's a great time to be in the trade area.
Excellent.
Thank you.
Thank you very much.
Okay.